Money, Money, Money Budget Special.
Hello and welcome to this budget special. We're here to decode what Finance Minister Arun Jaitley's tax proposals mean for your wallet and your wealth. I'm Surabhi Upadhyay, and joining me on the show is Navneet Manot, Chief Investment Officer of SBI Mutual Fund, as well as Gautam Mehra, Leader Tax at PwC India. Gentlemen, thank you so much for joining us on the show. It's great to have you on. But before I get down to the Q&A with our guests this evening, here's a quick snapshot of what Budget 2016 has in store from a personal finance standpoint. Now let's start with the good news first. And most of it is for small income taxpayers and the middle class, one could argue. Number one, the budget has hiked the rebate enjoyed by taxpayers with income less than 5 lakh rupees from 2,000 rupees to 5,000 rupees. So that's additional savings of 3,000 rupees straight away. Number two, good news if you are a non-salaried rent-paying individual. You can now look forward to higher deduction on rent. The limit has been hiked from 24,000 rupees to 60,000 rupees per annum. Number three, the budget looks to give a push to the NPS or the National Pension Scheme. 40% of the withdrawal amount has been made tax-free now. But here, let me start bringing in some of the negatives as well. So while 40% of the NPS corpus will get tax relief, the total tax exemption you enjoyed at the time of withdrawing your EPF money no longer exists. In a bid to bring some parity between the EPF and the NPS, 60% of the corpus withdrawn from the Employee Provident Fund will also be subject to tax now. There is another important takeaway for salaried taxpayers. Employers will now have to pay tax on their contribution to an employee's EPF on a contribution amount exceeding 1.5 lakh rupees. But if you thought that it's only salaried taxpayers who have reason to feel a little glum, well, here's what the budget has in store for the super rich. Income tax surcharge on all those who are earning income above 1 crore rupees has been hiked from 12% to 15%. And those who earn dividends above 10 lakh rupees a year will have to pay 10% dividend tax. Of course, there are more provisions on housing and, of course, on gold bonds and several other asset classes. We'll come to all of that and more over the course of the next half hour. So let me straight away get started with our guests. Navneet and Gautam, first initial thoughts. Let me ask you a very broad question, and that's the theme of this discussion. Has Budget 2016 succeeded in putting a little more money in people's pockets so they can spend more and at the same time try to invest more? Navneet, I'll start with you.
So the overall government spending has gone up within the constraints which were there in terms of the fiscal deficit target. Obviously, there is some money in the pocket, the transfer of money from the government's account to the consumer's account. But specific in terms of tax proposals, I'm not sure whether there are incentives where they have more money which can be, which is at their disposal in terms of additional savings or the discretionary spending. There are a number of other provisions which basically augur well from the overall investment perspective and the market perspective. And if you put a foundation for a solid macroeconomic stable environment, a good economic growth, corporate earnings go up and people have the opportunity of making money in the equity and the bond market, obviously the investments will come and they will make good returns. So I think that's far more important than maybe a little bit of tax incentive here and there.
Okay, well, they surely do bring a smile to people's face, at least on, the 29th of February, 1st March, immediate fallout after the budget. But Gautam, what do you think? I mean, the whole hope was that this time around, that'll be a way of spurring the economy as well, to give people more money to spend, thereby boost growth, at least to an extent. Has that happened?
Well, I would agree with, Navneet. I don't think there have been any significant proposals to put more money in people's pockets from a tax perspective or given any additional relief. And I don't think there were any significant expectations as well around that. In fact, if you just go back a week, the expectations were more negative about what's going to happen about, capital gains on listed shares and stuff like that. None of that has fortunately come through. So there have been a few things about, you mentioned, some of them at the start of the program. There's some incentives for a first-time home buyer. Sure. There's other stuff around that for startups, etc. But nothing which says, yes, I'm going to get so much more now in my pocket to spend.
So net neutral for the wallet. Should we look at it that way? At a headline level, perhaps. Okay, so let me now talk about some of the capital market provisions or the capital market announcements that came through today. Overall, the big fear, Navneet, of course, we know was that what if the definition of long terms is changed in the way long-term capital gains tax is applied? That's not happened. But at the same time, what does this budget mean for equity investment and for the thousands and millions of investors out there who've been watching this market fall, go through the floor, and are wondering what to do with equity as an asset class now?
So on a fundamental basis, one can argue about the rationale for imposing additional tax on the people who are getting dividends in their head. The corporate has paid the tax. After that, dividend distribution tax is paid, and then the money goes to the equity holder. But given that it's applicable to people who earn more than 10 lakh rupees out of dividends in a year, it's not going to impact the millions of investors that you are talking about. For them, I think in terms of overall tax provisions, nothing much has changed. In fact, there were fears, as he talked about, of the change in the long-term capital gains. But again, I'll repeat the same point that overall, if let's say the overall tax-free bonds, the number of tax-free, the amount of tax-free bonds that is going to be issued is around 31,000 crores. With the overall tax provisions, equity remains a very attractive asset class for large number of investors, and there are very little allocation as of now. After 1 year, you get a tax-free income by investing in equities. So I think that hasn't changed.
And that hasn't been touched. Gautam, would you agree with that? And also the fact that this 10% dividend tax, still now only companies are paying the dividend distribution tax. Now individuals have to, but only those who are earning dividends in excess of 10 lakh rupees a year. So is it sort of a signal to the super rich? Does this budget give out a signal? There's also the hike in surcharge that I mentioned earlier from 12% to 15%. So what's the interpretation for the so-called wealthy from this budget?
The finance minister has to collect taxes from somewhere as well. Overall, if you see, he did mention that the direct tax impact of these budget proposals is just a drop of about 1,000 crores. There is significant excess collection on the indirect tax side, but on the direct tax side, it was almost a neutral thing. I don't think this by itself would, signal something anti-rich, but yeah, there is a lot of logic in the argument that, you're looking at 3 levels of taxation, if I may say so, for that basket. The company paying the initial tax, then the company paying the dividend distribution tax, and then to top it up, the 10%. The finance minister's logic is an 18% dividend distribution tax is not, the right, because at the maximum level, you should be paying 30%. Right, and therefore it's a 10% top up to equalize that for the higher income tax players.
There were also some people who were arguing, saying why not let dividend income be taxed at the hands, or with the hands of the one who's receiving the income, and counted as part of overall income of that individual. That hasn't happened. So to that extent, is this better off, because otherwise it would have been a straight 30% cut, right?
No. So the proposal to have dividend income tax directly in the hands of the recipients would have also meant abolition of the dividend distribution tax itself.
Correct.
Right?
Yeah.
So that would have probably put more money in people's pockets, just to go back to the first question. But this is just an incremental outlay for the high net worth individuals, whether investors or promoters.
Sure. Navneet, on capital markets, quick final point, the slight increase in STT, the securities transaction tax. Of course, I know it doesn't impact the mutual fund industry as such, but is it just a one-day sentiment negative? Will it just be something that people learn to live with?
That's only on options. Of course, it impacts the liquidity because the option writers and the buyers are also providing indirectly liquidity to the overall market. But I think these things don't impact over a longer period. And as you rightly said, that from a mutual fund perspective, we are mostly into cash equities and a little bit of futures, so it doesn't affect us. So,
gentlemen, your thoughts now on the National Pension Scheme, because we're hearing more and more on this with every passing year. I mean, again, this year, they've not gone ahead to the EEE or the exempt treatment, which certain people were hoping for or were arguing for. But 40% of the corpus will not attract tax at the time of withdrawal. Let me come to you, Gautam, first, because at the same time, they've changed the taxation in terms of withdrawing your EPF amount as well. What kind of a signal is the government sending out here?
So the NPS did enjoy some incremental tax benefits over the other investments. So I think this is a way slightly to get parity between the two. Clearly, it continues to be an attractive savings instrument, given the tax benefits that are available at the time of the contribution, especially for the middle class and not so much for, I would say, the higher category individuals. So I think it's just a question of wanting to get some parity.
Navneet, how do you look at the NPS, given that there's such a big thrust now, and NPS, unlike EPF, has an equity component? So does the mutual fund industry have to sit up and take notice at all? I mean, if a large corpus now starts being pushed directly into the NPS, that's competing with pure vanilla mutual funds, isn't it?
So of course, mutual funds have got a long-term track record in terms of delivering good returns over a very long period, have great ability in terms of the overall investment expertise. and any kind of tax benefit which promotes the retirement security for citizens at large should be applicable, should be platform neutral, obviously. And I think mutual funds should enjoy a similar tax benefit. If anybody is investing for a long time for his retirement or his or her retirement, I think similar benefits should be extended to mutual funds, and the industry has been asking for it for a long time.
All right, gentlemen, we'll take a quick break. We've discussed a lot about equity. We'll also look at what Budget 2016 has in store for other asset classes, housing, alternate investment funds, and of course the government's much hyped gold, sovereign gold bond scheme and the gold monetization scheme. All that after the break.
Money, money, money. Budget Special.